Hey guys, what's up? Welcome to the channel. So we already know that when you own shares in a company, you basically own a portion of that company. And we do this with the intent of either gaining capital advances or dividend income. But how do we actually choose these companies? How do we know actually what to buy? Well, in this video, I will go over a technique that people use to uncover, to discover, to find stocks or narrow down that pool of stocks to make your decision in what to buy. Stay tuned and welcome to part 4 of Stock Market for Beginners. So for those of you who are new and for those who are returning, thank you and welcome to the channel. And if you guys don't mind me asking this, just go down to the bottom of the screen and press like, and when you're finished with liking this video, I would like you to leave a comment and let me know what you guys want to see next. And if you really love this content, just please subscribe and share it to all your friends. So without further ado, let's jump into the meat of the matter. So the technique that we are going to use is called the fundamental analysis, and traders or investors use this analysis to basically know the fundamentals or know the basics about a company. And you use the cash flow statements, the income statements, and also the balance sheet to derive ratios to help you in your fundamental analysis. So there are a lot of ratios to take into consideration when dealing with fundamental analysis. I will be looking at 5 in this video. And the first one that I want to look on is called the EPS, which stands for earnings per share. And this basically measures how much or the ability of a company to be profitable for each share of stock. So basically, let me break this down into an example, because examples put things into perspective. If company A has $1 million in earnings or $1 million net income and has 100,000 shares outstanding, that means you would divide the earnings by the number of shares outstanding and you will get a dollar figure. For this example, it would be $10. So basically, you would track the EPS annually, and if it increases, that means this company is basically profiting for each share they have. In turn, becomes a good choice or gives a check mark for your stock of choosing. Number 2 on this list is going to be ROE, and ROE stands for return on equity. Think of it this way: for you to go into the future or make a decision based on a forecast, you have to have previous data, right? This is what the ROE is. It's basically giving you data on how this stock has treated its past investors in order for you to make a decision on buying it in the future. The formula for ROE is basically net income divided by shareholders' equity. And shareholder equity is assets minus debt. And once we get the ROE, once we know the return on equity, it basically shows how efficient a company is at turning its assets into profits. Examples time. Company A has a net income of $10 million. They have assets of $50 million and debt of $20 million. So as we said, net income divided by shareholders' equity. So we'd have the assets, which is 50, and we have the debt, which is 20. That will leave $30 million. So we say 10 million divided by 30 million will give us 33%. And with that 33%, we would know how good this company is at turning its assets into profits. And the higher the ROE proves or means that this company knows what they're doing in order to get profits, and that's what we like. If a company has strong profits, that means they're going to have strong growth. Next on the list is profit margin. So if a company makes revenue, then the percentage of that revenue that goes to profit is your profit margin. And this is generally measured in a percentage. And the more profit the company retains, that means the potential for growth is increased. Example, if company A makes $100,000 in revenue and their profit is $10,000, that means their profit or percentage or profit margin is 10%. And if that increases over time, that means this company is good at keeping profits. And if they're good at keeping profits, or increasing profits, I should say, if they're good at increasing profits, then that means this company is going to the moon. Anyways, on to the next point. Number 4 on this list is going to be market cap, and we've mentioned this in previous videos, so this is basically a refresher. Market cap shows the size of the business, shows what category it fits in, if it's a small, medium, or large cap business. And to get this ratio, or to get this calculation, it's basically the current share price multiplied by the number of shares being traded, or the number of outstanding shares. So if you have a company with a share price of $10 and it has 10 million shares being traded, that means the market cap for this business is $100 million. It's basically easy, it's just to determine the size of the company. And when you determine the size of the company, if it's a small stock, that means it has a big chance of growth, but it also has a chance of failing because it hasn't proved itself as yet. And the larger the market cap means that this company is stable, this company knows what they're doing, but the chances of growth is small or even non-existent because they have reached their potential. So those are things to look into when you're deciding the market cap of the company that you want to invest in. Now we're going on to point number 5. So the last one on this list, and the most popular, which many of you guys have just heard thrown loosely around, is called the PE ratio, which stands for profit to earnings ratio. So look at it this way, and I'll give an example, which is the best way to learn this concept. So you have stock A, which is at $6. You have stock B, which is at $35, and you have stock C, which is at $132. So looking at those stocks at face value, most people will tend to go for the $6 stock because it seems cheaper. It's more affordable. It looks appealing to the normal investor. But are you really sure of the value you're getting for the stock? How do you determine if this stock is really valued properly? This is where the PE ratio comes into play. Because if a stock has a low price or a low stock price, doesn't necessarily mean that it is valued fairly and is valued at a way that you get a good earnings on your investment. So let me just go over the calculation for which you would use to do PE ratio. PE ratio is basically the stock price over the EPS. And since we already know that the EPS basically is net income divided by the outstanding shares, we already know what the EPS is. So now we just need to know what the stock price is. So we have company's A stock price, which is $6, and we have their EPS of 20 cents. We're just going to give them an EPS of 20 cents. By doing that calculation of their stock price divided by their EPS of 20 cents, then that means their PE ratio would be 30. So now we're going on to stock B. So their stock price is $35. We're going to give them an EPS of $1.40. Doing the calculation for company B with their stock price of $35 and their EPS of $1.40, that means their PE ratio would be 25. So we have a PE ratio of 30 for company A and a PE ratio of 25 for company B. Now we're going on to company C. Alright, so company C stock price is $132. We are going to give them an EPS of $3.90. Why not? I could just give them that, $3.90. After doing that calculation, their PE ratio would now be 34. So now we have company A with a PE ratio of 30, we have company B with a PE ratio of 25, and we have company C with a PE ratio of 34. After doing all the PE ratios and looking at the numbers we received, stock B, or company B, would be the most affordable according to the price to earnings ratio. Even though it has a stock price of $35, its price to earnings is 25, which is lower than the 3 companies that were given examples here that were stated here. So company B would be the most suitable for your investment, or most suitable if you're trying to figure out what to buy. So none of these ratios act independently, and knowing one does not give you a determining factor or does not put the nail in the board to make you choose that stock. There are more ratios out there, and it's best to know them or actually know what they mean. Some stock trading apps basically give you those ratios, but you still have to interpret those numbers and know what they mean. By analyzing all these, then you would break down the list or narrow down the list to know what do you want to buy or what do you buy. This has been part 4 of Stock Market for Beginners. My name is Demetrius Fairman. Thank you guys for watching my video so far, and thank you for the response. I love the support, I love the respect for the channel. I just want to keep it going further. Thank you for watching. I'm out.